Hello and welcome to this session. This is Professor Farhat. In this session, we're going to be looking at Section 351, which we're going to keep looking at Section 351 to be more specific. We're going to be looking at boot received, assumption of liabilities, and determining the stock basis. So we're going to be looking at three different major components of Section 351. If you don't know what Section 351 is, by all means, go back and view the prior to recording in this playlist where we talk about the basics of Section 351 and what happens if we contribute services under Section 351. This topic is covered in a corporate income tax course, the CPA exam regulation section very heavily, as well as the enrolled agent exam. As always, I would like to remind you, my viewers, to connect with me on a professional level. I'm very active on LinkedIn. If you don't have a LinkedIn account, you should create a LinkedIn account for professional growth and network with other professionals. If you have a Facebook, you can like my Facebook page and connect with me on a personal level if you chose to. YouTube is where I house all my lectures. You want to make sure you subscribe to my channel. Please like the videos if you like them, put them in playlist, share them, let the world know about them. And thank you very much in advance. I do have a Twitter and I do have a website. On my website, if I can find a CPA offer for you or some sort of an offer, I will post it there. And right now, Becker, the gold standard in CPA review, is offering for the first time an option for unlimited access for their CPA prep course. So if you go through my website, you will benefit yourself and benefit this channel. Let's talk first about Section 351 boot received. Now, what are we talking about here? Well, we're talking about Section 351. What is Section 351? Well, Section 351 is this. When we have shareholders contribute property to form a corporation, or they contribute property in return of stocks. So the corporation gives them stocks. What we say is, as long as we contribute property and we have control of the corporation, 80% control, there's no gain to be recognized. Simply put, if we contribute property and we happen to have a gain on that property, as long as we receive enough stocks, that's going to give us 80% control of this transaction, we have no gain to be recognized. So this is the background about Section 351. Now, what is the idea of boot received? Well, if Section 351 applies, which is we're going to say it applies, there's no gain or loss on property transferred. Notice here, unless. Now we're going to go into the exception. Unless boot is involved. What does that mean? It means the corporation gives you boot, and boot runs one way. So you cannot give the corporation boot. The corporation will give you a boot. Now, what is a boot? It means the corporation, they might give you, in addition to the stocks, they might give you cash, they might give you some sort of a property other than the company stocks. And we're going to see later that liability, if they assume a liability on your behalf in certain circumstances, we're going to see this shortly. Sometime, if you give them a liability, if you give the company a liability, simply put, if you give them a piece of property and that piece of property attached to it as a liability, or you added a liability to it, that might be considered a boot. We'll talk about the liability later. But this is the overall idea. So simply put, there is no gain unless the corporation gives you a boot. Boot means they gave you something else in addition to the stock of the company. That something else could be cash. That something else could be property. That something else is they assume a liability on your behalf. Okay? So this is what we're going to be talking about next. And we're going to be spending a lot of time in this, talking about this topic. So we have to copy this formula down. So copy this formula down. So how much gain do we recognize? So let's assume we receive a boot. Then if we receive a boot, we're going to have a gain. How much gain do we recognize? So copy this formula down. We're going to recognize gain, the lesser of, okay? The realized gain on the property transferred. What is the realized gain? Hold on a second. We need to go back and figure out what realized gain is. When you contribute a property, you would look at your fair market value minus the adjusted basis. And that's going to be the realized gain. Actually, this is another formula. Hopefully you know how to compute the realized gain. So this is the realized gain, or the fair market value of the property received. So you're gonna be recognizing the lesser. Recognizing means It's the taxable portion of the transaction, either the realized gain or the fair market value of the boot received, whichever is lower. So if we happen to have a realized gain of $300 and the boot received is 100, we'll go with the boot received. If the realized gain on the transaction was $500 and the boot received is 750, we'll go with the realized gain, the lesser of boot received or realized gain. So that's the first thing you need to know. How much gain do we recognize? Notice we recognize. Recognize means we're going to have to tax it. Recognize means the taxable portion. Important, very important here. Okay, taxable portion. Okay. Now also what we need to remember is this. Total recognized gain. So when we compute the recognized gain, we're going to include the fair market value of services transferred to the corporation. And this is important for basis. We're going to see later on. So when we say we're going to be adding the gain, the recognized gain, if you contributed services, then that's considered part of the gain. And this is important for the basis because we're going to be talking about the basis later. Okay. So what about losses? Well, we recognize no losses if we incur losses. And this is basically, we are being conservative. Well, you're saying, hold on a second. This is exactly the opposite of what I learned in GAAP. In GAAP, what we said, in GAAP says, recognize losses to be conservative and defer gain. Well, for taxes, it's the exact opposite. If you have a gain, recognize the gain, but no losses, because it's the exact opposite. So if we have any losses, we don't recognize the losses because we are being conservative. That's what conservatism in tax, which is the opposite of GAAP. In GAAP, if you have a loss, recognize the loss. Okay. So section 351, simply put, does not trigger loss recognition. Why? Because we are being conservative. If you have a loss, don't recognize the loss. Okay. The opposite exactly of GAAP. Now, if you have a gain, what's the character of the gain? Well, the character of the gain, depending on the asset that you are contributing. Sometimes it could be an ordinary gain. If you're contributing ordinary asset like inventory, sometimes it could be section 1231 gain, or if it's a section 1231 asset, or it could be a capital gain if it's a capital. Could be a capital gain if it's a capital asset. So depending on the type of the asset, will determine the type of the gain. Now, bear in mind that section 351 is mandatory. Okay, and why do I say this? Because it could be a CPA exam question. Section 351, yes. If section 351 exists, it's mandatory. Okay. Now, so we talked about the boot. So boot received. So what's the idea? One more time. If there's any boot received by the shareholder might have a tax consequences. What are the tax consequences? Recognize the lesser of realized gain or fair market value of the boot received. Now let's talk about the assumption of liabilities, or to be more specific, we're going to be moving to a new section, section 357. Okay. And specifically, we're going to have section 357A, B, and C. So we're going to start with A and break them down into separate components. Now, what's the big idea of section 357A, the assumption of liabilities? Let me just simplify it first, just going to give you an idea. If I gave you a car today if I gave you a car, okay, said, here's my vehicle. I paid for it. That's the basis for it. The basis for it is $15,000. Okay, this is the car that I'm giving you. Okay, and you would say, if I gave you this car, you would say, well, you gave me $15,000 worth of value. Okay, fair market value, or what you gave me is $15,000. Let's assume I told you I'm going to give you this car, but just want to let you know, before I gave you this car, I went to the bank and I took out a loan against that car, and that loan is $10,000. So now what I did is, in addition to the car, I'm giving you a loan. So you take the car, you're going to own the car, not a problem at all. I'm going to give you the car. But remember, in addition to the car, now you're responsible for the loan. So the loan is $10,000. How much did I give you in value? I gave you $5,000. Because for you to own that car, you have to pay $10,000. Why? Because you have to remove the loan. I gave you $15,000, but I gave you $10,000. So what's going to happen is the liability reduced the basis. What I really gave you is $5,000. Okay, so the same, hopefully you understand this concept. I gave you the car when it was free and clear, it was worth $15,000. When I gave you the car with the loan attached to it, well, and that loan is $10,000, I really gave you $5,000 of value. So hopefully you get this idea in your mind. So what is the basic idea of subsection A? or subsection A. When a liability is transferred to a corporation, the transferor must reduce his or her basis in the stock received. Why? Because if I gave you an asset and I gave you a liability with it, the amount of the liability would reduce my basis. That's simply put. Because I did not give you 15,000, I only gave you 5,000. And you gave me whatever you're gonna give me back. I'm gonna give you this car. You're only gonna pay me 5,000. Okay? And what I received is only 5,000. Okay? You're gonna give me something of 5,000. Let's assume stocks. If I gave you a car, so simply put, if I gave you the car plus the loan, the car basically minus the loan, I gave you 5,000 of value. You're gonna give me back 5,000 of value. You're not gonna give me more than 5,000 of value. Okay? So this is the basic idea of transferring a liability. Okay? Now, basis of stock received. Again, copy this formula down. It may be a little different than your textbook, but this formula, hopefully it will make sense. So what is my basis in the stock received? So when I transfer an asset to the corporation, so I transfer an asset, and I also with the asset, I transferred a liability, okay? And the corporation gave me back stocks. So what's my basis in the stocks? So my basis will start with the adjusted basis of the property transfer. What's my adjusted basis? And this is going to be abbreviated as AB. I'm going to add to my adjusted basis any recognized gain. What is recognized gain? Remember, if I transferred an asset and you gave me, in addition to the stock, a boot, and that boot triggered a gain, then that gain, if that gain is recognized, I'll have to add the gain. Now you might be asking yourself, just could you please explain to me, why do I add the gain that I'm going to be recognizing? Think about it for a moment. Once you recognize the gain, it means that gain is taxable. And if something is taxable, what it should do, it should increase your basis. What does that mean? It means when you sell it down the road, your taxes should be lower. The higher is your basis, the lower is your taxes. Therefore, if you already pay taxes on that gain, the gain recognized increase your basis, which in turn reduce your taxes down the road. So that's why you add your recognized gain. And I want to make sure you understand this. I mean, you can memorize it. I want to make sure you understand it. So you'll start with your basis. We're going to be working with numbers. I just want to make sure you understand the formula, but don't worry, we're going to work with numbers shortly. You add your recognize. Also, you add ordinary income from services. Remember, if you contributed any services, if you perform any services, that performance is bartering. Remember what we talked in the prior session. If you bartered, bartering is taxable. Therefore, if you already pay taxes on that service and you got value in return, that service is already taxable. It should increase your basis. Therefore, you'll start with your adjusted basis and you add to your adjusted basis any recognized gain based on the boot received of the formula that we looked at earlier, plus any ordinary income you received from services. Then you subtract the fair market value of boot received. So whatever boot received whatever boot received from the corporation, you deduct the fair market value of that boot received, and that's going to reduce your basis. Then you subtract liability transferred if it's not considered a boot. Now you might be saying, what does that mean if it's not considered a boot? Well, liability transferred not considered as boot. If it's considered a boot, it's going to be treated differently. Okay, so you would subtract the liability transferred. You might be saying, why do I subtract the liability transferred? Remember, if you remember the 15,000 minus the 10,000 is 5,000. You only gave 5,000. Therefore, reduce your basis by the liability. It's as long as it's not considered a boot. Now, if it's considered a boot, we're going to look at shortly. So this is basically the formula, which is, it will start to make sense when we put it all together. And this will be your adjusted basis in the stock received. And this will be the adjusted basis in the stock received. Once again, your textbook might show you the formula differently, but I could assure you this formula and the one in your textbook, it should work the same. And the best way to illustrate this, so copy this formula down and let's work it, is to work an example to see how this all works. Okay. So we have an individual that transferred the property of 100,000, adjusted basis of 40,000. Right there, we can say we have 100,000 minus 40,000. What we can say is we have a realized gain of $60,000. Also with that property came $25,000 liability. Now I'm going to be a little bit more specific. This liability has a business purpose. What does that mean? It means this liability comes with this asset. So basically it's attached to it. It's basically part of the property, but it has a business purpose. So the reason I took this loan out is because I was using this property for a business. It has a business purpose. So let's see what happened here. What is our basis in this transaction? What's the basis in the stocks? First, let's figure out our realized gain. Our realized gain we already computed is $60,000. Now, remember what I said earlier. If you relieve yourself of a liability, then you might have a boot. Now, here we are relieving ourselves of this liability, $25,000. However, this boot, this $25,000 boot, okay, we're not going to treat it as a boot, although we're relieving ourselves of a liability, is because it has a business purpose. If it has a business purpose, it falls under section 357 subsection A. So simply put, here's what we're going to go back here. If it is subsection 357A, subsection A, it means the liability has a business transfer, then it's not considered a boot. So this is what I meant to tell you earlier, liability transferred, not considered a boot here. So if it's section 357A, it's not considered a boot. So this liability is not considered a boot. So what is the recognized gain? Let's go through it. Recognized gain equal to the realized gain or the fair market value of the boot received, the lesser of these two. What is the boot received? The boot received is 0. Well, didn't you say the liability assumed is a boot? It's not a boot because it has a business purpose. Therefore, what's the realized gain? The realized gain is 0. Why? Because the $25,000 liability is considered, it has a business purpose, therefore it's not considered a boot. Therefore, my fair market value of the boot is 0. So the liability is for business purpose, no boot received. Now, what's the basis for the shareholder? What's the basis for the stock for the shareholder? Well, we'll start with our basis. What's the basis in the property transferred? The basis is $40,000. We'll start with that. Then we add any recognized gain. Well, we did not recognize any gain because there was no boot and we did not provide any service. Then we subtract the fair market value of boot received. Well, we did not receive any boot, okay, because this is not considered a boot. Then we deduct the liability transferred as long as it's not a boot, and this is not a boot. So liability transferred, not a boot, we deduct. Therefore, what's the basis in the stock? The basis in the stock is $15,000. Simply put, what am I saying is this. I contributed a piece of property with an adjusted basis of $40,000. Okay? With that, so I transferred this to the corporation. And remember, my basis transfer to the corporation basis because the corporation is an extension of myself. However, I gave them a liability with that of $25,000. Therefore, what I really gave the corporation, $15,000 based on my basis. Therefore, the corporation is going to give me a stock that's worth of $15,000. Therefore, my basis is $15,000 because if I kept this asset, my basis in this asset is technically $15,000 basis, not fair market value basis. And why it's that? It's 40 minus 25. I have an adjusted basis of 40,000, a liability of 25. My adjusted basis is technically 15. If I gave this property to the corporation, basis for basis. My basis are 15. Their basis is, they're going to give me $15,000 worth of basis. So this is an example of section 357, subsection A. The liability is not considered a boot. Why it's not considered a boot? Because it has a business purpose. It has a business purpose. Let's take a look now at section 357, subsection B and subsection C. Well, what's the big idea here? Here we're going to assume that the liability, it has no business purpose, or the liability has a business purpose. So this is what we're going to be looking at. So we're going to have two rules here. Rule number one, if there's no business purpose for the transaction of the liability, then the liability is treated as a boot. Simply put, what does that mean? It means we took this property, this warehouse that we're contributing, and before we gave this warehouse to the company, before we contributed, we went out there, we took a loan against the warehouse, and we took this money and we went on vacation, on personal vacation, or we spent this money, we bought a personal vehicle or a personal boat, whatever we did. There is no business purpose for the loan. Okay, so we're given a property that has a liability, but the purpose of the liability is not business purpose. If the liability is attached to the property transfer, then there's a business purpose for the liability transfer. What does it mean if it's attached? Well, it means if it's a mortgage property, then the liability is attached. It means the liability is attached to the property. Then in those circumstances, it's considered business transfer. Okay? Now, this is rule number 1. We're going to work some examples with rule number 1 before we move into rule number 2. So let's look at rule number 1 first, when there's no business purpose for the property. Okay. So let's take a look at this example. We have individual A that transferred property of $100,000, adjusted basis of $40,000, and liability with no business purpose. Notice here, no business purpose. This is exact the same sets of facts as a previous example, except we're going to assume the liability. This owner took the liability out and went on a personal trip. All right. Now, what do we have to do first? Well, now this liability is considered, now this is a boot. Now we're dealing with a boot. So we received $25,000 boot. Well, we have to compute the realized gain. Well, the realized gain is the fair market value of the property minus the adjusted basis. The realized gain is $60,000 as in the example before. Now, what's the recognized gain? Well, the recognized is the lesser of the realized gain, $70,000, or the boot received. The boot received is $25,000. Which is the lower of these two? $25,000. So we have a gain of $25,000 recognized gain. Once again, why is this recognized gain? In the previous example, it wasn't. It's because the $25,000 is for no business purpose. So we took it out and it was for personal use. So that's the recognized gain. Now, what is the basis for the shareholder? Well, we'll start with the basis of the property contributed, which is $40,000. Then we add to it any recognized gain. Well, we do have a recognized gain. We're going to pay $25,000. We're going to pay taxes on this $25,000. Therefore, if we're paying taxes, it's going to increase our basis, right? Because if we already paid taxes on this, it's going to increase our basis. Less fair market value of boot received. Guess what? We did receive a boot. Receive a boot of $25,000. What is the boot of $25,000? They relieved our liability. Less liability transferred. There is no liability transferred here. This is not. So this $25,000, not a liability transferred. This $25,000 is a boot. Why is it a boot? Because it has no business purpose. Therefore, our basis is $40,000. Let again from a common sense perspective, basis is $40,000. Then I paid taxes on $25,000. Then I received something for $25,000. Well, it's going to be those two basically cancel each other out. My basis is $40,000. Simply put, I received $25,000 worth of goods, but I pay taxes on that $25,000 worth of goods. Well, I received it, I pay taxes. Basically, like what's left is only the $40,000. So this is an example of Section 357, subsection B. The liability is considered a boot. The liability is considered a boot. Let's take a look at one more example similar to this one. Then transfer real estate with a basis of $140, fair market value of $190. Right there we have $50,000 of realized gain to a controlled corporation in return for the stock. So Section 351 applies. However, shortly before the transfer, Dan mortgaged the real estate and uses $20,000 of proceeds to meet personal obligation. Basically, he took out a loan and paid his credit card. Okay, personal obligation. Well, this liability now, we're dealing with a boot. Oops, we're dealing with a boot here. We're dealing with a boot. So we already computed the realized gain. And what's the recognized gain? The recognized gain will be the lesser of $50,000 or $20,000. Therefore, this is the recognized gain, $20,000. Okay? So in this case, the assumption of the mortgage lacks a bona fide business purpose. There's no business purpose. Consequently, the release of the liability is treated as a boot received. So how do we recognize the gain? The gain recognized is 20,000. As I showed you, it's either 50 or 20. Now the question is, what is the basis? What's the basis? Well, the basis is this. The basis is 140. The property basis is 140. Then recognize a gain of 20,000. Then receive the boot of 20,000. So the basis in the stock for then is 140,000. Okay, 140,000. Now, as we talked a minute ago, we looked at rule number 1 when there's no business purpose. And we worked a couple examples. Now let's look at rule number 2. What's rule number 2? Rule number 2 basically state there's no business purpose. If there's no business purpose liability, it ain't all liability transferred. What does that mean? Let's assume you transfer a property. Part of the liability is a business purpose, and part is personal. So part of it is business. It's a legitimate business. You have a loan for a legitimate business, but part of the liabilities you transfer is for personal. Once you have a personal loan against that property or within the deal, then it corrupt all the liability. So everything else will become a liability in a sense that it's a liability. In other words, it's a boot. Everything now triggered into a boot. Okay, so let's take a look at an example for rule number 2 before we go into section 357. So individual A contributed a property of 100,000, adjusted basis of 40. So far so good. So the realized gain is 60. With that property comes a $25,000 business purpose loan. So far so good. However, before individual A contributed this property, they took a $10,000 loan and they went to Las Vegas. They took a Vegas trip. Well, guess what? This Vegas trip is a personal loan. Guess what? You tainted everything. So this loan tainted this loan. Now everything is considered a liability. Well, what does that mean? It means we have a boot. Well, let's go through the fair market value of the property transferred minus the adjusted basis. We have a realized gain of 60. Now the realized gain, how much of it is recognized? It's the lesser of the realized gain or the boot. The boot is 35,000. Everything now is considered a boot because that $10,000 personal trip to Vegas tainted everything. Now, so the recognized gain, we're going to recognize gain of 35,000. So boot received, yes. Why? Because personal liabilities taint all liabilities, corrupt all liabilities. What is the basis for the shareholder? Well, it's the basis of the property contributed 40,000. Add any gain, which is we're pay taxes on 35,000 minus any boot received 35,000. There's no liability transferred. Again, those are boot. Those are not liabilities. Okay. Therefore, will give us a basis of 40,000. So basically, this is section 357, subsection B, personal liability taint all liabilities. So we looked at rule number 1. We looked at rule number 2. We just looked at rule number 2. Let's look at section 357, subsection C. When does subsection C kicks in? If the business purpose liability transfer exceeds the adjusted basis. Now we are transferring a property, but we have a liability that's attached to that property and the liability exceeds the basis. You might be saying, is that possible? And yes, let's assume, just for the sake of an example, you have a home or you have a building. You paid for that building, let's assume just for the sake of illustration, 100,000. And let's assume this is your basis. Now that building, the fair market value of that building is 300,000. The building went up in value. If you go to the bank and you say, I want a loan for 250,000, the bank would say, yes, we'll give you a loan for 250. Although the basis, what you paid for it, we're going to assume this is the basis, 100,000. Here, the liability, 250, is more than the basis. So it could happen. It could happen where you transfer this building where the liability in excess of the basis. So that could happen because the bank doesn't care. The bank has the building and the building is worth 300,000. So they're willing to give you 250 of a loan. Okay. So if the liability exceeds the adjusted basis of the property, then the excess amount is boot. So what's the boot? So in our situation, we said a loan of $250 and the basis is $100,000. Guess what? We have a boot of $150. That's what we're looking at. We have a boot of $150. So what's the amount of the boot? It's the liability minus the adjusted basis. The liability is greater than the adjusted basis. Now, let's assume we have section 357 and section 357C both apply. So in a situation, you might have business 357. 357 is a business purpose. If there's no business purpose, depending on rule number 1 or rule number 2, and there's section 357C. If they both apply, we assume it's a section 357B. So we would look at the transaction and we treat it as we treat section 357B. So let's take a look at an example where the liability exceeds the adjusted basis. Individual A contributed a property of $100,000, adjusted basis of $40,000. Again, we have a realized gain of $60,000. The liability attached is $50,000, and this liability has a business purpose. So notice here, the liability is $50,000. The liability is $50,000, which is more than the adjusted basis, but it's a business purpose. So what is the boot here? The boot is $10,000, which is the liability minus the adjusted basis. The boot is $10,000. Now we have a realized gain of $60,000. We did this like for the 4th time now. What is the recognized gain? The lesser of the realized gain, $60,000, or the boot? The boot is $10,000. Okay. So what do we have here? Recognized gain of $10,000. Recognized gain of $10,000. Was there any boot received? Yes. And the boot received, not because of this, the boot received is the liability. I wanted to put this down here. Liability exceeds the adjusted basis. Okay. So what is the basis for the shareholder? Well, this is going to be interesting. We're going to have the basis on the property transferred $40,000. We're going to start there. Then we're going to add recognized gain, which is we're going to recognize gain of $10,000. We're going to subtract the fair market value of the boot received. Then we are going to subtract the liability transferred. Subtract the liability transferred, not considered a boot. Now, what is the liability transferred not considered a boot? Well, the liability transferred is $50,000, of which $10,000 is considered a boot. So $40,000 liability transferred, not a boot. Remember, when we have both sections apply, section B will win. Simply put, the adjusted basis is 0. Simply put, we cannot go below 0 under the adjusted basis. So in this situation, we have an example where the liability exceeds the adjusted basis, but remember, the $50,000, it has a business purpose. Therefore, the only $10,000 of it is boot, and the remainder will be a business purpose. And if the liability is business purpose, remember, we subtract the liability transferred. Now, we talked about the shareholder's prospective basis. Now we're going to look at the corporate basis, because also the corporation would like to determine what will be their basis in the property received. So, basis and property received for the corporation. Now we're looking from the corporate perspective. If section 351 applies, here we go. They're going to take the adjusted basis of the property transfer. Remember, the shareholder transfer basis. Remember, it's goes from the shareholder to the corporation, basis to basis. Then the corporation would add any gain recognized by the shareholder, but they don't include ordinary income from services. They only recognize, they add any recognized gain by the shareholder. Now, when would the shareholder have any gain recognized? The shareholder would have gain recognized when there's a boot coming back from the corporation. Remember this. So it's the adjusted basis plus recognized gain by the shareholder. This only happens when there's a boot coming from the corporation, equal to the adjusted basis. So basically, the carryover concept applies. Property basis carry over to the corporation, unless the corporation gives you a boot. Then if the corporation gave you a boot, and you increase your basis, well, that's going to increase the base, and you recognize a gain, whatever that gain is, the corporation would recognize an equivalent gain. Okay? So any liability transferred to the corporation is simply recognized as a liability on the corporation books. So any liability transferred, so if you transfer a liability, the corporation will have to carry the liability on the books. They cannot treat it anything else. If you transfer 10,000 worth of a loan, they cannot treat it anything else because the bank, the lender, the creditor, they want to be paid 10,000. So the corporation cannot say, well, you gave me 10,000, I'm going to record it as 8. Well, you can record it as 8, you're still responsible for 10. So the liability transfer to the corporation will be exactly that liability. Now, if Section 351 does not apply, so if there was a transfer and Section 351 does not apply, then the adjusted basis will no longer applies. Then whatever you contributed, we have to use the fair market value of property transferred. So the adjusted basis only applies in Section 351 transfer. If the Section 351 does not apply, and you contribute something to the corporation, we no longer use the basis, we use the fair market value. The fair market value. Okay? The fair market value. And let's take a look at an example that's going to illustrate some of the concepts that we learned in this session. So let's start with the first example and see, hopefully put this all of this together, or at least most of it, if not all of it. Okay? So we have this individual here. Ali forms B Corporation by transferring land with a basis of 125, fair market value of 775. So Ali, simply put, transferred something that's worth 775,000. So what do you expect Ali to receive? And based on just, based on what common sense. Well, if Ali transferred something for 775, you would expect Ali to receive fair market value of 775. Okay? Now, this asset is subject to a mortgage of 375. 1 month prior to incorporating this company, Ali borrows 100,000 for personal reasons and gives the lender a second mortgage on the land. Well, hold on a second. What happened here is Ali took out a loan, and that loan is a personal loan. Remember, once we have a personal loan, it's going to taint all the loans. Okay? So B Corporation issues stocks worth of 300,000 to Ali and assumes the mortgage on the land. All right, let's see. So what did Ali transfer? Ali transferred, let me just make sure the business makes sense here. Ali transferred 700, a fair market value of 775,000. What did Ali receive in return? Well, Ali received 300,000 worth of stocks. Well, that's not good enough because I gave you 775,000 worth of property. Plus, we gave what Ali did, relieved a loan of 375. Well, that's not good enough. Then also the corporation relieved another loan of 100,000. So notice, this is the first loan. This is the first loan. And this is the second loan. This is the personal. So this is the business, and this is the personal. Regardless whether it's a business or purpose, simply put, Ali is happy because Ali gave up 775. Ali received 775 in value. So the first thing you want to make sure when you're looking at these examples, you want to make sure everything makes sense in a sense that what the shareholder gave up, the shareholder is expected to receive in total value. Now the question is, what are the tax consequences? Well, what are the tax consequences? We have to know what's the realized gain, if any, for Ali. What's the basis for Ali? Well, let's see what's the realized and the recognized gain. So what is the realized gain first? Well, we have 775 minus 125 minus the adjusted basis. This is the adjusted basis of the property, adjusted basis. So we have a realized gain of 650. This is realized gain of 650. How did we come up with the realized gain? It's what we contributed minus the adjusted basis. Realized gain is 650. We don't include the liabilities in this computation. Now, what is the recognized gain? How much gain are we going to recognize? Well, since this is considered a boot, remember, this is a boot. Why it's a boot? Because of the 100,000, that personal loan. Well, the recognized is the lesser of 650, the lesser of 650, or 475. Why 475? It's the 375 plus 100,000. Well, the recognized gain is the lesser of these two is 475. 475. Now, what is the basis in this property for Ali. What's the basis? Well, we're going to start with the basis transferred, 125. Okay, basis transferred plus recognized gain is going to recognize $475,000 worth of property. Not worth of property, 475 worth of recognized gain. Then he did receive 475 of boots because they relieved this liability. That's all considered a boot, minus 0 liability transfer because all the liability here is considered a boot. So minus 0 liability transfer, that's not a boot. None of it is considered a boot. So 125 plus 475 minus 475, it's 125. Therefore, the basis for Al is, the basis, keep skipping. The basis for Al is 125. Now, what is the basis for the corporation? Well, the basis for the corporation is, remember the formula, it's the basis of the shareholder plus the gain recognized. Sorry, keep skipping now. Okay, so 125 plus the gain recognized, which gives us 600,000. This is the basis for the corporation. Okay, my pen is giving me a hard time now. Okay, this is the basis for the corporation, 600,000. Okay, now, how would the tax consequences to Ali differ if Ali did not borrow the 100,000? So what we're asking is this: what happened if Ali did not borrow the 100,000? So simply put, Ali did not borrow the 100,000 for personal reasons, did not borrow this money. So what do we have to assume? We assume here that all the money, all the loan, the 375 is for business reasons. Well, we're going to have to go through the transaction again. But let's see what we have here. Let's erase all of this and see what we have here. Let's erase all the ink. Now, notice we have a basis of 125. We have liability equal to 375. Hold on a second. Now the liability exceeds the basis. Remember, in this situation, we have a liability exceeding the basis. In the prior example, yes, the liability exceeded the basis, but everything was considered a boot. Because if B and C exist, B will take over C. Here, we only have a liability exceeding the basis. Situation. So now what we have to do, first we have to compute the boot. The boot equal to 375 minus 125. The boot equal to 250. Now we have to compute realized gain to figure out the recognized gain. Okay, so the realized gain is 775 minus 125. 775 minus 125, whatever it is, it's going to be more than 250, more than the boot. Therefore, the recognized gain is the boot. Okay, the recognized gain is the boot because 775 minus 125. Okay, that's going to be 650. This is the realized gain. Well, the realized is more than the boot, so this is the recognized because we have to choose between those two. This is the recognized gain. Now we have to go through the process and figure out the basis for the shareholder. Well, we're going to start with the basis 125. We're going to add recognized gain. The recognized gain is 250. We're going to subtract the fair market value of boot received. The fair market value of boot received is 250. Remember, the boot received, Debut received is 250 and recognized is 250. Then what we have to do here, we have to subtract the portion of the loan that's not a boot, because remember we gave a loan of 375. Of that loan, 250 was considered a boot. Well, the remainder of this loan, which is 125, is not considered a boot. It's not considered a boot. So only the amount that's in excess of the amount in excess of the basis. Therefore, we have to reduce by 125 as well. Reduce by 125 by the amount of the liability that's not considered a boot. Therefore, the basis of the shareholder is 0. But what does it mean the basis of the shareholder is 0? It means if the shareholder sells the stock that the shareholder owns, Ali, sells the stock for any amount, all the amount is taxable because the basis for Ali is 0. The basis for Ali is 0. So any amount that Ali sells the stock for in the future, it's going to be all gains. It's going to be all taxable. It's going to be all taxable. This is what we mean by the basis equal to 0. So lower basis means higher taxable income in the future. Now, what is the basis for the corporation? The basis for the corporation is the basis of the property transferred, 125, plus the gain recognized by the shareholder. The gain recognized by the shareholder is 250. Therefore, the basis for the corporation is 375. Okay, so these are the topics that we covered. Notice quite a bit of topics. Take your time, work additional exercises. If you have any questions, email me. And if you happen to visit my website for additional lectures, please consider donating. Good luck and study hard for your exam.